Hi everyone, welcome to this live event. As usual, I'm here to share with you my view of the market for this week. Let's see and check the fundamental calendar to start to see what we have there to work with and what's going on with the technical picture, okay? First, I would like to say that there's a couple of things that happened last week. There are huge market mover. Of course, the first one was the Bank of England extending its quantitative easing, its facilities programs, well beyond market expectations, right? Carney was quite rough. He cut rates to record lows, 0.25%. He extended the quantitative easing program plus another easing added. And well, today we have one of the Bank of England members, McCarthy, saying that it's in more easing is on the table should the economy keeps showing signs of slowdown, right? So that's the main reason why today we had the pound dollar trading below the 130 figure, and I do believe that this is a heads up, right? As we could expect the pair to keep on falling, probably reach 25 during the upcoming days. Or weeks probably, but overall I'm expecting further slides there. The other main event we had last week was the US payroll, right? It was well beyond expected for a second consecutive month. The market forgot about the dismal May reading, but once again, I do believe that the odds for a September rate hike stand now at 18%, just 18%. Meaning the report was strong, the dollar benefited temporarily from the reading, but it's by no means it's enough to trigger a Fed rate hike this year, right? It could maybe advance it a bit towards the first half of next year, but for the most, we're expecting the Fed to add in the second half of 2017, and despite the number was good, it had a little influence over the market, and we are going to check that out in the charts in a few, right? I still believe that the yen is strong. I still see the OC poised to test this year high, right? Pound it's down on self weakness. The euro is doing nothing, right? Summer is kicking in hard because of the reduced bonds we are seeing. So overall, that's the general picture that by no means signals dollar strength, okay? Not in general, at least. Anyway, we had plenty of data over these days, but nothing really relevant going on in Europe or the US. The most interesting things that came out today were inflation in China, right? The consumer price index that keeps shrinking, right? It keeps on falling, okay, as expected. Yes, not much significance, but it keeps falling month after month. Was a slight hope in here because it has improved slightly monthly basis, and what I'm seeing is that producer price indexes, which remain in negative territory, at least they're improving also, but still inflation is a problem not only in China but all around the world. Anyway, the positive numbers were enough to boost the OC. We're going to take a look at that in a few. We have also had the UK trade balance, right? And there was another readings, but I focus on the trade balance because we have the trade balance deficit pretty much double previous one expectations. There was downward revisions. The fact is that things are really bad in UK, and despite provisions tend to be, or forecasts tend to be negative already, considering we're talking about June, July, which is when it was the Brexit, right? And the negativeness of figures surpasses the already bad expectations we are having in UK. So that's no good news for UK. This we are going to have a really big number in a few hours, which is the NISR GDP estimate. Okay, it's a 3 month view, but it's from July. So we are getting near data from after Brexit, and it will probably be really, really negative, and that will be another hit in the chin of a pound for today, right? The US calendar will be pretty light, but don't expect any good number coming from the UK when it refers to June, July. I guess the worst is not yet over in the United Kingdom. We are going to have a raft of negative data, and maybe we will see some light at the end of the tunnel in August from the data, okay, but not before. Anyway, and for the upcoming days, right? Reserve Bank of Australia Governor Stevens will speak tonight in the upcoming Asian session. It has the tendency to be a hawk, right? We have seen Australia cut rate twice this year, and in general, we have uh, the idea that that's not the end of the rate hikes, but still, I would expect Stevens to be a bit more hawkish, considering things are not doing so bad in Australia, and the only problem seems to be inflation these days, right? Alongside, after Stevens, and the next really interesting event will be the Bank of New Zealand, expected to cut rates following Australia. They have hold on, but they can't anymore. But of course, this is not going to affect much European currencies, but indeed will weigh on the antipodian ones. So the Asian session from promised to be much more interesting than the upcoming Asian sessions that the European American ones. As you can see, the calendar is pretty much empty in Europe and in the US. Nothing really relevant. On Thursday, we have some minor readings in Europe coming from Italy and France, but honestly, this is hardly able to move the market. Same goes for the US. I believe that in here the most interesting um, reading will be the initial and continued jobless claims. And you know this is not a big market mover, right? So down to Friday, I do believe that it would could be a bit more interesting with Chinese data and inflation in Germany. I would think checking the forecast, we're not expecting big changes in the year. And the fact is that unless we have a couple of months of readings above 1.0 or 1 point something in Europe, in the Euro area, in the UK, in the US, inflation won't be enough to trigger real rallies across the board. The next relevant figure will be GDP in the Eurozone, right? It's for the second quarter. It will have a bit of a data coming from the UK, but ever since UK is leaving uh, the euro area, I don't know what we are going to see in here from now on. A big market mover, probably a big disappointed, will probably put the euro on the 110. Okay, and I do believe that the start of the week will be indeed retail sales in the US, expected on Friday. Sorry. As you can see, we are expecting a modest advance during July below previous month readings, but not negative. Of course, as usual, this is the market will react according to the result of these numbers, right? If we have a positive surprise following the negative surprise coming from Europe and the UK, then this probably will fuel further the dollar's rally. I won't be paying too much attention to the consumer sentiment index. It has not been as big a market mover as it was lately, right? Previously, I mean. And inflation at producers' levels, I'm neither expecting that to be big influence during the upcoming sessions. Okay, let me change to charts. Okay, there we are. As I was saying, there's almost anything going on in euro. We have that 2 week rally, right? And all of a sudden the payrolls have the pair reach and briefly fall below the 61.8% last Friday. And for then on, we have been trading at 50 pips range, not even 50. quite contained below the 50% retracement of that rally, right? That was the 2 week rally, right? The 50% comes around 110.95 or so. And the level is it's containing rallies. Overall, if we change back to the daily chart or even bigger, we will see that the pair has been lacking certain directional strength, for quite long, right? There's no directional strength in here. Market is not sure what to do. I do believe that in part it's to blame on Draghi because, well, he launched full armor in when it comes to quantitative easing earlier this year, and afterwards, he has been in a wait and see stance and has not reacted to all of the uncertainty the Brexit is generating over Europe, right? He's not reacting to that. He did nothing. He's not making big statements or announcing measures or being confident that those measures are not required. He made some comments in earlier in its latest statement, monetary policy meeting. But actually, he's not taking a serious position, right? So that is fueling the uncertainty over the destiny of the common currency, and therefore the market is rather staying aside of it than betting on a slide or a recovery. Anyway, there we are with not much to say. Uh, the pair has been hovering around 10.15, right? For most of the time ever since Brexit. It has been like an inflection point and a magnet area coming back and forth to that level, to 100 pips to downside or 200 to the upside, but then back to this region. And right now it's also the 61.8% retracement of that last 2 week rally. So I would say that we need to clearly break below that region, below the Friday's low, 10.45 in fact, to see the pair falling, right? With the next probable targets being the 10 region, the 10 level, right? And below that, 960 seems the next logical target, and below 960, 910, which is the post Brexit low, okay? I was looking at 1120, right? 1120 has been a major resistance for over a year already, right? Over a year and a half. And we have the 38.2% retracement of this rally at 25, right? So unless the PR can close the day or at least a 4 hour candle above this level, the upside seems limited for me, and probably we will be seeing, selling interest on approaches to this region, okay? Unless we have a big trigger, I don't know, a statement from the Fed, a statement from the Bank of Europe, whatever. But I don't see that triggers coming. Those triggers coming these days, right? So uh, this is for me like a small line in the sand. If we can go past this level, then the pair will look a bit more bullish and probably return to the 1160 region. Uh, and that's the most I can see it right now. I can see it moving much more than that during the upcoming days, okay? And for the pound, well, as we were saying earlier today, one of the Bank of England members announced that they're willing to do more easing if required, right? And that came after the bank already is last week, and the US payroll, right? So we are pressuring the lows. We have set a daily low around 29.60 so far. I do believe the pair has scope to extend its decline, particularly if the upcoming GDP uh, estimate, right? Sorry, it's also a big disappointment. In that case, I do believe that the pair has scope to go to 29, 10, 20 in the short term, I mean, right? Below that, we have 28, 60, 50 region, and below that, the 28 low. Still, there's uh, room to continue sliding. And if we extend and remain below the 130 figure for a couple of days, the risk will turn too big towards the downside, and the possibility of a recovery above it will be quite limited, right? So overall bearish in pound. Sorry, I forgot to mention probable resistance level, and of course 3020, which was the previous low from last week. And if you take a look, we have multiple lows and highs in there in the 4-hour charts. And today's high, I believe, was still a couple of pips below it, is the immediate resistance. And above it, the pair can go back to the 3060 region, where we also have a lot of intraday highs and lows, really strong static support as the pair has been trading above it and meeting buying interest for over a month before breaking lower. Okay, and for the Aussie, I believe that we discussed this scheme last week, and we continue to develop within it, right? This is the year rally. We fell to 61, recover, found support in the 50, recover, found support in the 38, recover, and now we are holding above the 23.6% retracement of this year decline and pressuring the highs, right? We have this region 76.75, I believe was, yes, July high. We are pressuring that level overall. And despite Australia cut rates 1.5, it's still way too much compared to other economies with negative rates or 0 point something, right? So rates are still quite high in Australia. It's still a good deal to buy the Aussie, and the market is doing so. Mostly, I do believe that the recent support has came from recovering oil prices and the positive mood we are seeing in stocks, right? So as long as that remains, the market will probably keep on buying the Aussie also as a high yielding investment. Okay. Anyway, I would accept that this previous high in 77.20 is the next support if we take today's high, and I'm expecting the pair afterwards to extend up 7830, which is this year high. Okay, uh, of course 76, it's the immediate support level to watch. I still believe that approaches to this level could be seen as buying opportunities as long as we don't take them, we don't have big events, right? Like Savings or the Reserve Bank of Australia or the New Zealand Central Bank also in the middle, right? The pair can briefly fall below that level and then recover, but this is the line in the sun, and if we and I don't see it breaking clearly below it still. And if somehow the pair moves down, as long as above 74.50, I believe that the bullish trend won't be at risk. Okay, so beware of that. Beware of pullbacks. Beware. Consider buying on lower levels. Considering placing your stops around those Fibos, which seem quite relevant for me. Okay, and remember we talk about self strength. Well, the Japanese yen is still strong, right? If you take a look at your daily chart, this is clearly a bearish trend, right? And pullbacks to the 100 moving average in the daily chart have been steadily attracting selling interest. And the K chart maintains its bearish slope. So everything in here is telling me that the yen has room to keep on advancing against the green bar, which means the pair could fall down. Yeah, indeed, it has recovered partially, but compared to the previous slide, the pair did not even recover the 38.2%, right? It was barely a corrective movement. Okay, let's see, 23.6. So overall, I still believe that the risk is towards the downside. The price is developing below its moving average in almost any big time frame. So there's a little chances of a big comeback in this pair unless I don't know, we have a huge surprise coming from the US, right? And that is a rate hike, non-announced rate hike, probably in September, something that will hardly take place, right? So overall, I'm sticking with my bearish view to this pair. I would like to see it below 100 or 190, right? To talk about taking a bearish trade. 100, 150, and 101 are the next supports. Now, I found that something quite interesting uh, last week. I was thinking about Kuroda and economics and when the economics started and all that. And I found out that 100.6, right, where the pair has style multiple basis many times, right? And even also over these past 3 months, right, is exactly the 50% retracement of the yearly rally, right? We are talking about the pair. This is October 2011. This is last year high, right? This huge Fibonacci support around 101, 100.60, sorry. So yeah, spikes below that level down to 100 are possible, but we really need to at least close a week below that level to confirm that the pair could break lower on 93.80. Seems the probable bearish target then in the long term. It's a major level, the one we're pressured. Take a look at this is a weekly chart, right? How many times the price still around that level. Take a look at the daily, you will see something pretty similar happening around 100.6. Okay, so that's a major support, and we are hardly 150 pips away of that level. Anyway, shorter term, that's the key for me. To the upside, 260, 100, 330 are the resistance levels I will be watching for this week. And above this last, maybe the pair can go up to 104, but I'm really not seeing much more going on towards the upside. I have some profit taking, some upward corrective movements, some particularly positive report triggering a bullish rally, but overall the risk remains towards the downside. I'd rather wait for the pair to end up an upward correction, sell again, than a risk buy. Okay, and finally, gold prices. The commodity has had a nice comeback, right? And all of a sudden, the payroll sent it boom down, plummeting, erasing almost 1 week and a half of gains. Ever since the week started, the price has been flat around this 33, 35 region, strong static support, which is telling me that the selling interest around the commodity is quite limited, right? There's not much selling interest in here. There are no buyers either, but at least it's not plummeting. So this the fact that after the payroll it held around those levels, uh, probably also due to the strong upward momentum in the stock, is telling me that the downside remains limited, and there is still room for some further recoveries. I could say 1342.50. It's the immediate resistance above that level. I would be daring to buy. I'm going for a retest of the 60-70 region, right? This year high. And above this, the commodity story can go up to 1400, as we discussed a couple of weeks ago. Also, I'm not seeing much more of an upward potential from that level, but 14 seems a probable target. Okay, and towards the downside, as long as we hold above 1308, which is the 38.2% retracement of the latest bullish rally, I don't see much of a downward risk in there. Okay, so pretty much that's it. What we're waiting for this week. Okay. Anyway, thanks for being here with us and for me, and see you back soon. Okay. Thank you and bye bye.